Hi again, I'm Drane, Principal of Ray White 7 Hills. Well, in February, we actually saw some stability with a dramatic slowing of the rate of price declines in the housing market across the country. This is the smallest fall since May of last year, but of course it's still a fall. Sydney was the main reason for this deceleration, thanks to a 0.3% increase in housing values. This stability coincides with a reduction in advertised stock, as well as a rise in auction clearance rates. Nationally, listings were around 17% lower than this time last year and a good 11.9% below the previous 5-year average. I'm sure you're curious about the auction clearance rate. In Sydney, it bounced back to 70% in February. The important question is whether this slight improvement is within everyone's ability to sustain. Listings remain low and the housing demand and buyer sentiment might easily drop further as increasing interest rates remain a disincentive. It's difficult to say. Experts are saying that things will stabilise and housing values will bottom out as interest rate upticks end. But have they ended? The RBA remains aggressive in its monetary policy to fight that bogeyman called inflation. Up ahead in the landscape is something most economists are describing as a cliff. This will be the point when fixed interest rates expire, and we'll be finding out how many households have buffer of cash in their offset accounts. We're not sure how the RBA's aggressive monetary policy against inflation will play out. Of course, we still need to put all this in the context of recent history. Values are still higher than pre-COVID levels, with only Melbourne now equaling March 2020 levels. In Sydney, our values are still around 7.7% higher. In February, we actually saw a national rise in weekly listings, but this was just seasonal. The volume was still low compared with previous years. The jump in new listings to 11,250 more than the previous 4-week period is still higher than we'd normally expect at this time of year. However, this jump only brought the number of new listings to a figure which is still below the previous 5-year average, 12.6% below in fact. It looks as though prospective vendors have put the idea of selling on hold for the time being. If you want to follow the trend of housing prices, keep an eye on the flow of new listings. That's what I'm here for. Right now, I can tell you that an above average increase in listings will have an effect on housing values. Now to rentals. Sydney has experienced a 16.7% increase in unit rentals over the past year. Weekly rental values have jumped 19% higher than they were at the onset of COVID and are predicted to jump another 11% this year. Again, these pressures seem to be forcing a trend towards higher density rental living, where rents are traditionally lower. Of course, this means a corresponding drop in house rentals as opposed to unit rentals. There only seems one major reason for this. Prospective renters seem to have reached the limit on where they're willing to pay. What all this means for the broader Australian economy is that people will likely pull back on spending in order to have a roof over their head, leading to further slowing. So far, there has been a lag as households have continued to spend unabated despite interest rates. Economics is not a science everyone thinks it is, and it's hard to tell whether the word of the ABA boss for low will ring true. The only higher interest rates that will lead to lower employment levels and lower inflation rates. But he assures us that this is only a credible path, and we can only trust the RBA has its hands firmly on the wheel. Time will tell. Tune in next month, and hopefully the news will be better. I'm Drane, Principal of Ray White 7 Hills. I'll see you next month.